All right. Wherever you are, whoever you are, why ever you are, I hope you're having a good time. I am here today because I want to teach the masses about how to sell options like a god, because it's been nice. Like, I took a little hiatus from the day-to-day trading to pursue other affairs and just move on with my life for a little bit. And I came back and people are starting to sell some cash secured puts and some covered calls. I'm like, okay, now y'all are starting to get evangelized. And the thing is, you guys are a snowflake sitting on top of an iceberg, this massive iceberg of all that selling options can bring. And if you guys knew all of the intricacies, all the ways that you're potentially leaving money on the table, and the ways that you're potentially exposing more of your portfolio to risk that you don't have to necessarily, I think that the game would be changed for you. So today, what I want to do is we're just going to touch on the surface. I'm not going to go into like the serious, like multi-leg, like, butterflies and horizontal and diagonal spreads. We're just going to talk about it from the top. And if you can follow me on this and you understand what I'm saying here, then, we can really start to get kind of freaky with it, and it's going to be fun. So, I'm under the assumption right now that you've seen my previous video that I recorded a few years ago going over the wheel strategy, right? If you don't know what that is, pause this video, go watch that video. Essentially, what it talks about is selling puts and selling calls and why those two things happen, what happens when you sell a put, what happens when you sell a call, etc. Okay, so I'm under the assumption that you're familiar with those two concepts, because selling puts and selling calls, cash secured puts and covered calls, are the building blocks of spreads as a whole. Like, if you don't understand what those two things imply, then you won't understand what any of the spreads that are being opened imply either, or what they do or their purpose. Okay, so now, first thing that I want to talk to you guys about before we get into the nitty gritty here is that there's three kinds of spreads, directions that you can choose from. Okay, so let's look at them real quick and let's talk about it. So you can have a vertical spread, which is what we're going to talk about today. We're going to talk about 4 different kinds of vertical spreads. And a vertical spread, essentially, in the least nerd talk ever, is saying when you open up a spread where the expirations of all the contracts involved in the spread are the same expiration date. Okay? So if it's October the 5th, then that means that the put that you sold and the put that you bought are both expiring on October the 5th. If it's a call spread, same concept. January the 18th for the sold call, January the 18th for the purchased call. Okay? Same concept. The only difference with vertical spreads is just where you're selling. Okay? And I'll show you examples of what that looks like here in a second, but I just want you to be able to get this visual. So this is purely based off of, as you can see down here, this is the expiration date. The vertical spread has no change in expiration date. The only change is in the strike price, okay? So if vertical means that the expiration date is the same and that the strike prices are different, what would horizontal mean? Or calendar spreads is what you'll hear them be referred to. I love me a good calendar spread. Calendar spreads are the exact opposite, basically. The expiration dates are different, so you can sell the front and buy the back, right? When I say sell the front and buy the back, that means your sold options are expiring sooner than your purchased options. The difference is the expiration dates, right? So maybe you have a sold call for January the 18th, and then on January the 26th, you have another call that you purchased, and they're the exact same strike, but the expiration date is different. Then finally, right, and this can go for puts as well. You can do a put calendar as well. You have diagonal spreads. Arguably, the biggest money that you can make in a spread, like I would say, is through diagonal spreads, unless you have a massive volatility event that happens and you've got a horizontal spread opened. The reason why is because diagonal spreads are when you sell the front once again, right? You sell a strike In this example, it's saying that your sold option is lower, but actually I would flip this. I would have my strike that I sold to open be higher for my calls, and then have my purchased option, my leaps that are way out in the future, be deeper in the money. But this is just how they drew this. I pulled this off of Google, so, take it with a grain of salt. But a diagonal spread means that there are different strikes and different expirations. And the reason why I think that a diagonal spread, also you'll hear me refer to diagonal spreads as PMCCs, which is a poor man's covered call, is imagine, right? It costs right now for a share of Tesla, or actually to buy 100 shares. I'm sorry, I'm clicking on the wrong screen here. I got like 3 screens in front of me, so Lord forgive me. Let's see here. Tesla, perfect. $42,700 to purchase 100 shares of Tesla. But imagine, right? Here we go. Perfect. So imagine though, you can go out right now and you could purchase a 450 call on Tesla, right? At this exact moment, the market's open, so this should be updating automatically, for $4,740, right? Let's look at the historical chart here. That's beautiful. Somebody purchased it down here. This would have been at like $1,500. So their $1,500 has grown and is now chilling at just under $4,800. That's amazing. So if you bought leaps, your leaps position is up like 300%. But what if I told you that you could also, at the exact same time as having this leaps contract, right? Because this doesn't expire until, really I should choose something that's a little bit further out in time, but for the sake of this example, we'll leave it be. You could be selling calls as well against this position, and you could say, yeah, I don't think we're going to get up to, I don't think we're going to get up to 470. Where are we at? 470 this week, right? We're going to buy a call here. We're actually going to delete one of these, and then we're going to sell a call as well. Beautiful. Okay, so we're going to change the expiration date on this bad boy. Bum, bum, bum. So you can see this example in real time. All right. So we're going to do 450, and then we got 470. So I know this looks absolutely insane, and you're like, Hunter, what? Oh, wait, I did that wrong. I did that backwards. Let's see. I need to leave this expiration in the future. Let's just remove it. All right, here we go. Perfect. All right. Here we go. So we've got our call that we've purchased. We're going to put this out in the future. Change that expiration. January 16th. All right, much better. All right, here we go. So in this example, what we're essentially saying, and I know that you're like, I am not following anything that's happening here. So when we sell to open, we're selling a forward expiration. So that way we have the potential to sell here, and we could sell here, we could sell here. Sorry, this is glitching out on me. I don't know if this is gonna let me. Okay. Here we go. So we could sell here, we could sell here, we could sell here, we can sell here, and here, and here, and here, and here, and here, all the way up until we get to where our leaps expires. And every single time that we sell, we're able to collect a little bit more money. Obviously, the premium of this contract has pretty much disappeared because the market's only open for like another few more hours. Then you roll it, $250 more. You roll it, this will probably be closer to $400, $300. You roll it, are you following what I'm trying to say here? Like, depending on where you choose for your expiration to be with this sold position, because you don't have to sell every week. You could sell every quarter. You could sell however long you want to. But that premium that you're collecting is going to decrease the amount of money that you're pulling out from your spread. But I'm sorry, that's like really tangential, and that's actually deviating pretty hard from what I need to talk to you guys about today. We're going to talk about vertical spreads, right? So let's actually get into it a little bit here. I don't mean to get too tangential. All right. So we'll use Tesla. We'll keep it up here for the exact same continuity of it all. All right. First and foremost, I know you're looking at this and you're like, Hunter, what's going on? What does this mean? What is this website? And how do I interpret the numbers that I see in front of me before you start talking about all your spreads? All right, let's take a little tour. This is OptionStrat.com. I don't know why everybody on earth does not use OptionStrat.com. I am not affiliated with them in any way, shape, or form. Wish I was. They're a really great company. I love their products. I've paid for their products in the past whenever I was more active trading options. I just think it is the best thing since sliced bread. It's so simple and easy. And so this up here is going to tell you the kind of spread that you're entering into. It'll even give you a little excerpt about, what it is. See, put credit spread. We'll go over that in a minute. Tesla, this is the name of the underlying, the price. If you don't pay for it, it's delayed by 15 minutes, but you can refresh it and it'll give you an updated number. Expiration, it'll tell you how many days you got till expiration right here. 21 days at October 17th. That's crazy. This year is flying. And each one of these represents a different day out in expiration along the options chain. You just click on the date that you want. Pretty straightforward here. Strikes. These are your strikes. Anything that's a bubble down here is sold to open. Okay, so you'll notice that there's a -1 that's drawn right here. Sold to open. Okay, that means you wrote the option contract. You created the contract. It'll tell you exactly what it is, the underlying, the strike, the expiration. The price here is the amount of premium that you either paid or received. And then here is all of your stats, your information, right? You got your IV and open interest, your volume, your ask and your bid, all of your Greeks here, just the first Greeks, not your second order Greeks or anything like that. I don't really feel like you need it to make money trading options. And then, of course, you have your net credit if you're opening up a credit spread, but if we were opening up a debit spread, it'll show net debit, right? We'll talk about that in a little bit as well. Estimated margin, you only need margin if it's a credit spread. If it's not, it'll just show you your max loss, okay? So, yeah. And then if you do use margin, it'll tell you your max loss. Your max loss is going to be calculated by taking whatever margin you had to put up and then subtracting your net credit that you received from it, okay? So pretty straightforward, pretty simple here. Also, it gives you your break even in real time, which is really nice. And then, of course, if you pay and you upgrade, you get access to all of your Greeks here. And then this is just a visual diagram for the gains. It does go up above 100% because there actually are spreads that you can take for trades that will give you greater than 100% returns. And what's nice is the losses are capped and the gains are capped. So you can still, even with a capped gain, take home, depending on how risky you get with your spread, you can take home just as big of a return as you would have with, a regular option. It's just the only difference is you've capped everything. So it's defined risk from the moment that you open up the trade. Like, you're going to leave here with anywhere between this or that, right? And it's pretty straightforward. Like, either we're at or above 425 at expiration, and if we're at 430, anything above that, you're at 100% gain. You don't have to trip. You know that you're going to take home the bacon. You know what I'm saying? It's great. This down here, this says date at 3 p.m. This is showing you at expiration. You can toggle this to see what your spread's profit and loss looks like all the way up until expiration. You can see that the lion's share of the gains don't happen until that back half of the week. That's why I'm always in a good mood on Thursdays and Fridays whenever y'all would have me doing any lessons or teaching and talking and everything. It's great. No max loss either until you get closer to expiration. So, if it's looking ugly, it's looking mighty grim, on Tuesday, Wednesday, or whatever, and the price is still moving up, you're still in it. You know what I'm saying? It's not over till it's over, unless you see that, hey, there's a better opportunity somewhere, I can cut my losses here and just go. It's let it cook. Like, literally let it cook and let your nuts hang, because you got to believe in what you're doing. If you actually put in the work with the charts, then go for it. And then, of course, this toggles the range, right? So, I highly doubt that we'll see Tesla at $150 anytime soon. So I personally just keep it like within 20% with something that's super volatile, just so I can really see what's going on here. But you don't have to even go that deep. You can go as low as like 5% even. And then, of course, my favorite, you're not going to see any changes here when I toggle this, but you will if I toggle the time, so I'll show you. This is the volatility IV indicator. You can reset it back to where it was just by simply hitting the reset button right there in the corner. So as volatility expands and contracts, it will change the way that your spread is like showing profit or showing loss. And with credit spreads, we are hoping with all of our might that we see implied volatility collapse, which is why anytime that I hear people talking about swinging options through earnings, I'm like, you are so far behind, but you will learn eventually, because probability wise, right? What we are doing when we sell an option going into earnings is we understand that implied volatility it surges up, right? It juices the premiums on those contracts going into earnings. And then following the earnings report, IV crushes, right? It collapses. So therefore, a portion of that premium that we were able to collect whenever the implied volatility was expanding, that extrinsic value, that's going to go to us, right? We're going to get to win on that situation. You're saying, well, Hunter, what if you're wrong about the direction and the price? Well, that's the only thing that you're really having to fight up against, is making sure that, you catch something that's, ideally the best case scenario, you open up a position that looks something like this, right? You open it up here, and then the stock goes whoo, 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 and it stays just flat. It opens up and it's the same price basically, and IV crushed all those people. You will receive pretty much like 60% of your net credit, especially if it's an earnings report that's on like a Wednesday, and then you got Thursday, Friday, market opens up Thursday morning. You're going to be very, very, very happy seeing nothing but green candles off a blue chew, if you know what I mean. So, all right, now that I've taken you through the tour, also this dotted line here, if you're wondering what that is the current price. So that's like telling you, okay, we're right here in price. And then obviously these numbers here represent prices of the actual underlying Tesla stock, and then this right here represented on the y-axis is telling you, hey, this is the gains that you're seeing, right? So, boom. All right, now let's get into it. So, like I kind of touched upon earlier, a lot of you guys are interested in cash secured puts, covered calls. And I know that one of the first things that you thought of whenever you started selling cash secured puts was like, damn, that's a lot of collateral. That is a lot of collateral. And they're always telling me to do it on stocks that I don't mind owning. But the stocks that I don't mind owning are more expensive now than they've ever been before. So what do I do in that situation? Like, that sucks. My portfolio is only, 5, 10K, 25K. I can't afford to put up $42,500 to sell a put on Tesla, right? Like, that's a huge amount of money. That's insane, right? I get it, first of all. Like, that was my problem too. And that's why I became such a fanatic about spreads. So the only difference between a cash secured put and what we have here, bull put spread, which I'll explain in just a second, is that rather than you putting up the collateral to own 100 shares, you take from this premium that you received when you wrote this contract, you take a portion of it and you use it to purchase, at the same time that you sell it to open, you use it to purchase a put. And that put that you purchased is now insurance for the put that you sold. You follow me? You get what I'm saying here? So like you collected $1,538, but instead of you taking all $1,538 at the expense of $42,500, right? Because the 4250 put, $425 put requires you to pick up 100 shares, right? So you put your zeros on there, 42,500. That's a lot of money, right? Instead of doing that, you could just say, at the same time that I'm selling this, I want to actually pick this up. And so you spend 1,108 of those $1,500, right? Oh, geez, Louise. There we go. Of those $1,538 to create insurance on this position, okay? So what happens in this scenario? Well, this spread is 10 points wide. What does that mean? What is the difference between 425 and 415? 10, right? So every point in difference, every dollar difference between your strikes equals out to $100 of margin that you're going to have to put up. For me personally, I pretty much never ever go wider than 10 points because then you start having weird liquidity things going on. It's just keep it simple. 10 points or less. You could make the spread 5 points wide if you like it. You can make it 10 points wide if you like it. I like 10 points wide because that's when you start, taking in hundreds of dollars, multiple hundreds of dollars. And I like the risk rewards that I can sometimes get from a 10-point spread rather than having 458 million 5-point spreads. Just is a little bit easier for me. But you do you, boo. You know what I'm saying? I'm not here to judge. I'm just here to teach. So you say, okay, well, Hunter, this is great. Like, wow, I'm impressed. I like it. Well, good. That's really great because bull put spreads are essentially the same thing as cash secured puts, except you don't have to have the cash to secure it. You use an option to secure it. And the reason why it's called a bull put spread is because when we do anything as a seller, everything that we know about options flips because we're on the opposite side of the transaction, okay? So we're selling puts. Selling puts is a bullish endeavor, okay? Selling puts means you want the price to move up. You say, Hunter, what? Why? Because we're not buyers anymore, right? We're sellers. And options are a zero-sum game. So if somebody purchases a put from me, right? If I'm selling to open a put and somebody buys it from me, I'm hoping to collect all of their premium. If the option expires worthless, like 90% of options do, then guess what? That means that I am the champion and that I get to take home all of their money. That's literally what I was doing during the pandemic. I was selling options to people who were taking on risk that they shouldn't have. And like, I go into this detail like way more in my actual like lessons and stuff. But for here, I just want to scratch the surface. I don't want to go into the deep complex math and confuse you or make you feel, like you're inundated with too much. I just want you to understand it's a zero-sum game and that when you sell options, you need to think of things flipped. So for put spreads, you'll know that it's a credit spread, number one, because you're going to be collecting a credit, but number two, because it's called a bull put spread. When you are selling puts, it is bullish. So notice when I flip this and it becomes a debit spread, that means that we're paying out money. It's now a bear put spread. So a bear put spread or a debit put spread, right, is essentially the exact same thing as purchasing a regular put. You're a buyer. You're not a seller. Even though you have this leg that you've sold, this is just helping you cap your gains and losses here, essentially, okay? What happens is this helps to reduce the amount of cash that you outlay to get into a put position. So however many times you've been like, oh, my portfolio is too small for me to get into a Tesla position because like, for me to pick up this 415 put is $1,100. My portfolio is 10 grand. I'm not putting 10% of or actually 11% of my entire portfolio's value into one option that expires in 2 weeks. Like, I'm going to blow up my shit. Like, I don't want that. That's horrible, right? So this is another reason why vertical spreads are so incredible. And, if we were really getting into the nitty gritty and if you guys wanted a video on it, I can absolutely make one. But when I start talking about ghetto spreads, right, legging into a debit spread, some of you guys actually leave bread on the table And with the PDT rule in place, where I don't know if that's going to be a thing anymore. This might be a problem of the past, but when the PDT rule was in place, it still is, but for portfolios under 25,000, and you already used your mulligan, you reached out to the broker, you said, hey, please, I'm sorry, I won't do it ever again. They said, okay, but you only got one, right? So you used your mulligan and you had this great position and you opened it up and it went for, 400, 600% in the same day. You could, in theory, leg into a debit spread and take profit on that position synthetically, right? That's what a ghetto spread is. It's legging into a debit spread when you've got a position that's already up 300%, 400%, and taking some of that profit. The moment that you sell to open, you create a debit spread. So what happens is, essentially, if the trade goes completely against you, you didn't actually lose any money. You already took the profit synthetically when you opened up the spread. It's great. But if the position keeps running, you opened up a spread, my friend, you get to double your dose. You still get to make more money on top of it. So you actually come away with a bigger gain. And because you didn't actually close out the position on the day that you opened it, right? Because you already used up all your day trades and you couldn't. So you had to swing it through the next day. You can then close out the spread the next day or whenever you really wanted to. And you'll still be able to take home all of your money without using an actual day trade. So you win across the board. And that's like the biggest, most incredible trick of outthinking the problem, right? When you understand how spreads work, there's just a million different doorways that open for you. So let's keep this rolling, right? Bear put spread, same thing. We just talked about the fact that it's the exact same as just simply buying a put. And the only difference is you've now capped your losses. So now instead of you taking an $1,108 loss, you're only risking $255, right? Like, who wouldn't want to risk that? Like, imagine if two people took this same trade. Somebody took the put trade with $1,108. You took it with $255. Both of y'all won $495 of profit at the end of the trade. Who took the better trade? In my opinion, I would say the person who put up less money but got the same results took the better trade. So this is why I'm like, y'all, if we're talking spreads, and we're talking about really trying to make money in this market, why are you risking so much of your portfolio? People talk about risk management. Like, yes, but risk management, you can, yes, obviously from a technical perspective, you can have risk management, but there's a lot of great risk management that comes in from taking on the kinds of trades where you're capping the amount that you can lose anyway. So it's all about just execution and precision and making sure that your, technical setup looks right. But even for people who aren't super technically inclined, like I wasn't, I used this to help me while I was getting more well-versed with the technical side of things, because basically with a put spread, and in this example, this is a put debit spread, so, bear with me here. Your break even is the only thing you really have to pay attention to. All that I'm saying in this trade is I just need us to be, ideally, we need to be at around 407-ish, 407.50, right, where our sold strike is, or 405 was where we'd really be comfortable, right around here, right? It'd be great. But in reality, as long as I'm below 412.45, I'm leaving here with something tonight. Like Denzel Washington was saying, I'm leaving with something tonight, baby. All right. Hopefully I blew out some eardrums there. Let's go. You got to keep you on your toes, right? I can't have y'all falling asleep sitting upright at your computer screen. That ain't it. So, all right. Where do we go from here? Well, I guess I'll take you through briefly a little bit about the bear put spread, but it's pretty self-explanatory, I think, right? So same concept here. We sell to open the 410 put for $933, and we purchase a 415 put for $1,108. Now you're saying, oh, Hunter, this is different. This is different. We're actually collecting less money in this situation than we were whenever we had it flipped and we were, selling the 420 instead of the 410. Exactly, my friend. You are so smart. You are going to make millions of dollars in this market at this rate. That's why it's a debit spread. That's why it's called a bear put spread, and it behaves just like a regular put, because you're still a buyer in this situation. You did not finance this put through selling this one. What actually happened is you just reduced the amount of capital that you're exposing yourself to losing through this option contract, okay? So collecting 9, doling out 11 gives you roughly 200, and this spread is 5 points wide, so there you go. 500 minus 200 gives you 300, roughly, right? I'm simplifying this. Obviously, the numbers are different, 175, 325, right? So this is how these spreads work, and this is why I'm like, yo, if your account is $10,000 and you're really genuinely trying to get to 25K, there's no and especially if you're working a 9-to-5 job and you've got other stuff going on, there's no reason why you shouldn't consider opening up spreads. And obviously, with a debit spread versus a credit spread, it's going to have completely different behavior whenever implied volatility changes. So let me just show you that briefly real quick, and then we'll move over to the call side of things, and then you guys are going to be ready to cook. Ready to cook. Okay, so think about it like this. We talk about all the time. I'm so big, so big on talking about the Greeks and getting you guys to think about these options as more than just, little money tickets. When we are option buyers, we are hoping that volatility does what? Pause the video and answer that question if you can. We are hoping that volatility expands, right? We want volatility to increase, IV to increase. Why do we want IV to increase? Because IV is extrinsic value, right? And as extrinsic value increases, the premium on our option contracts also increases. Therefore, we as option buyers are making more money, even if the underlying isn't changing in price. Now, when implied volatility starts to expand, the probability that price action is going to move in one direction or another is that's like they go hand in hand. But we are hoping that implied volatility will expand, and we're, purchasing these options before some kind of binary event happens, or any kind of announcement or something that would cause volatility to spike, so that way we can benefit from that expansion in extrinsic value, right? So boom, let's show a visual aid, a visual example. We are 3 days into opening up this spread, right? We got 11 days remaining. Sorry, my brother has a sports car and he's in and out of the house, so if you hear a bunch of crazy sounds, that's him. I apologize. Yeah, let's say the implied volatility goes from 53 and it doubles, right? We're about to go into earnings for Tesla, and people are excited because it's got like an AI bot that will wash your underwear and give you a foot massage when you get home, right? Boom. Look at that. Right? Look at how our break even pivots out in this scenario. So now we're up 20% on a position that before the expansion of implied volatility, we were down 5% on. This is how quickly it happens when you have a spread open. It's like moment to moment. You're like, holy smokes, what's going on? When volatility is going crazy. Do you guys remember the GME, the GameStop thing that was happening, a few years ago now? I can vividly remember opening up a calendar spread at that time and being blown away by how quickly the gains were coming in, because the extrinsic value was just going ballistic. It was going nuts, right? On the same side of the token, though, it's a game of musical chairs. When that volatility crushes back in, the option sellers are going to be eating. They're going to be on their... They're going to be fat cats, licking their paws, loving life, right? So, just something to keep in mind, right? Going into earnings, why wouldn't you? Why wouldn't you, whenever you know that implied volatility increases leading into earnings, why wouldn't you? Then close it out, get yourself, and honestly, you really could open up a debit spread. Like, if you're going to swing something through earnings, let it be a debit spread and not just a naked call or a naked put, because yes, it's defined risk, right? But also, when implied volatility collapses and you feel like, oh my God, I just got IV crushed. This is insane. Remember, at the end of the day, regardless of what happens with the volatility, your risk is defined. You just need the price to be where it needs to be. Could you tell that? See, even if implied volatility is all the way down here at 0, you still just need it to be here. It just makes it a little bit more painful for you the whole time. But like I said, if implied volatility is moving upward, I mean, you know, you can be sitting pretty, right? You could be sitting real pretty. So, I hope you're understanding what I'm saying here. Bear put spreads, that's just a regular, it's like having a regular put. The only difference is you're reducing the cost to get in. Bull put spread is like a cash secured put. The only difference is instead of you having to have the cash and collateral for all 100 shares, you only need the margin for the width of your spread, baby. Same thing on the call side, y'all. Please don't think that that it's so much more complex on the call side. It's literally the exact same. A bear call spread is a call credit spread. Okay, bear call, bull put, both of those things are inverse, so we know automatically when we're thinking inverse, we're sellers. Okay, I can't drive that home enough to you guys, right? I just want you to remember that. So when we're talking about the call side, it's the same situation, same idea here. 10 points wide, y'all know how I do. 10 points wide, I don't really like to do anything more insane than 10 points. Depending on where you are along the options chain, it is going to change the amount of credit you'll receive and your risk profile. Anybody who's, done any lessons with me or I've ever taught, y'all know that I use the Greeks to be able to measure my risk. So I'm not going to go over that and inundate you with more information there, but just know the market needs her pound of flesh. So don't be swimming naked when the tide pulls in, because it's going to be a rough time, and I don't want to see y'all struggle. I want to see y'all thrive. So, same situation here. We know that this is a credit spread. So, we automatically know if this is a credit spread that the option that we're selling to open is worth more money than the option that we're purchasing. That is how this works, okay? When you are selling an option that is deeper in the money than the option that you are buying, that is going to be a credit every time. When that is inversed and you are buying an option that is deeper in the money than the option that you're selling, that is going to be a debit spread, okay? Same situation here than it is on the put side. So let's talk about it. Let's just kind of walk through it. I'll make it real brief, try to keep it short and sweet. I know we're already, how many minutes in? Okay, so let's start here. We collected $2,388 and we paid out $1,850 in insurance here, right? So that leaves us the net credit of $538 roughly dollars. And because the spread is 10 points wide, it's $1,000 of margin. So you only have to put up $1,000 of collateral instead of $42,000. Automatically, I'm loving it, right? No McDonald's, but I'm loving it. Max loss, what can we lose? Well, if we put up 1,000 and we receive a credit of 537, all that's left for us to lose that is there to risk is $462. Why? Because when we receive a credit, that money goes into that's like we get the money, we receive it, right? You say, oh, well, I can just go and do what I want. Well, I mean, kind of but the thing is you already put up the margin. So you're not going to get to have an extra $500 there and you're like, oh, I have $1,500 more dollars. I could just infinitely open these up and then it's an infinite money glitch. No, it doesn't work like that. The margin already, all of this is baked in, all right? So you receive the credit, and after you close out this position, the maximum, if you were to be completely wrong and you hit max loss, right, you are going to be down $462 in total on this trade, as opposed to being down, right, if you had just decided, you know what, I feel like I want to be selling to open the 420 call, I'm feeling a little bearish, the covered call situation, well, it blasts through it, you have to fork up your shares, you take away, you come away with a little bit of something because you picked up your shares, Lord willing, at a better price than $420 per share. but it just, you're risking less, and you're not having to risk forking up 100 shares out of your portfolio of something that you actually might have really liked, right? And maybe if it was running like crazy, or whatever, right, you're only losing a little bit. Some people really do like the underlying. And so in this situation, because this is a bearish trade, you're like, okay, well, like, what happens when I'm wrong? Well, if you're wrong, you just lose this money here. You don't have to lose your shares. But ideally, what we're going for in this scenario is we're hoping that our sold option here, we're hoping that this expires worthless for the buyer, right? So if it expires worthless, we take home 100% of that bread. And then remember, we financed it with $1,800. So net, all in, we would make $537, right? So when you're risking, all things considered, when you're risking $462, this is a 116% trade, right? Like, and you don't need the stock to go crazy. This is 116%. So, like, I'm trying to get y'all to kind of understand. So let me bring it to you like this. When you're taking positions at, $1,500 a pop or whatever, you got a portfolio and it's, 50, 60 grand. Can you see how something that's this simple, you only need a 2%, a 3% move to give you 116% gains? Like, do you see how this is super easy for you to build up your portfolio? You have defined risk here. And on top of that, right, we talked about volatility and how that changes. If volatility crushes and you're getting IV crushed, it's okay. At expiration, this is the same trade. It's the same, right? If volatility is expanding, you're just getting to double your dose earlier. But at the end of the day, it's the same trade, right? So, man, I can't say enough good things about spreads. This is the bearish call spread. So this would be like a covered call without forking up the money. And then a bull call spread is the same thing as just simply buying calls, right? So now, once again, if we're looking at this position, right, what can we tell just from looking at where these strikes are? We are selling to open a cheaper option, good googly moogly, here we go, than what we are buying. Therefore, we're just simply reducing the cost to get in. Net debit, we're paying out $397. Max loss, we are also receiving $397 is our max loss, right? Whatever we put up. Our max profit, however, because this is a 10-point spread, is going to be $602. So that means that we're looking at a 152% gain, or I should say 152% return on our risk that we're putting up, okay? So super, super solid trade, and we only need a 3.2% move to make it happen. By October 10th, that's like child's play for Tesla, right? So this is just, once again, same kind of situation. Because this behaves very similar to a long call, expanding implied volatility benefits us, right? We love to see implied volatility expand because let's say that we were at 435, right? This shows that we're up 3.6%, yeah? Let's see. 435. Try to do that math. Yeah. Yes. So, is that right? Yeah, it is. Okay, cool. So, when implied volatility shot up, we're up 3%. Versus, if it didn't, where was I at? 345? Or 435, excuse me? Yeah, okay. So, implied volatility, it's the same concept here, right? If implied volatility starts to expand, we're better off. It starts to kind of flatten out, but that's simply because we have to wait, right? Theta has to eat up all that extra extrinsic value. But eventually we get to the same place. This is the cool part about having your spreads go like having your spreads open through like volatility events, right? At the end of the day, it's going to change how it looks in the short term, but as long as we get to where we're supposed to get to and where we've mapped out, like, you're looking great. I knew a guy during the pandemic who used time fibs, and I taught him about spreads, and he was a sniper, surgical. I hope that he's doing well. Shout out to Chef Money. But yeah, like, just, this is the bare bones basics, the scaffolding to building out more complex option strategies, such as my favorite of all time, an iron butterfly. You're like, Hunter, what are you talking about? This looks insane. I know it does, but Tasty Trade actually ran some back testing for like 20 years. It's insane. I don't know how Mr. Sosnoff and his team does it, but they are just so awesome. And he was like, yeah, if you break a wing on your butterfly, like 75% of the time, those hit. They work. And obviously, like, he doesn't specify, breaking it to the downside or to the upside. I think that's kind of dependent upon where you've set your profit peak at. But I would imagine that if you were to build these out around key levels and break a wing, you're going to be, like, in great shape. If your drawn liquidity is a little bit lower, then just set your peak up, right, where at a psych level, a strong psych level, break your wings so that when the draw on liquidity does happen, it doesn't absolutely blow you up, and be cool with it. 16% is still leaving with something, but if you're, super surgical and you get your profits to hit right around this peak, it can be extraordinarily lucrative, right? Imagine you're getting paid $890 and you're only risking $360. Like, come on now, right? That is 239%, and this is just something that's like at the money. It can get pretty freaky. It can get crazy. One of my best trades that I ever made in my entire life on a spread was an iron butterfly on Amazon back when it was trading at like $3,500 or right around like 35 to I built it around 3,500, and I think I broke my wing at 3,200. I opened the trade up with Randolph, actually. Shout out to Randolph if he's still on socials. That is the GOAT when it comes to options trading as well. Love him. But yeah, I mean, this is that's essentially it, right? So I'll leave you with this image, and just, want you to keep this in mind. Look at it before you go to bed in the morning, at night, and when you wake up in the morning. And yeah, if you can understand what all of this is saying, this will change the game for you. So I'll read it off, break it down a little bit, and then I'll let you go, because I've been yapping now for 47 minutes. Goodness gracious. So bull put spreads, right? Bull put, that is a put credit spread. Anytime that you hear bull put or bear call, that is when you know it's a credit spread. And sure enough, there it is, bear call, bull put. So you're going to, for a bull put spread or a put credit spread, you're going to buy a put at a lower strike price, and you're going to sell a put at a higher strike price, because the put that you're selling is going to give you more premium than the put that you're buying. So you financed the put that you purchased using other people's money, okay? They're going to have the exact same expiration date because it is a vertical spread, right? You follow me? Ah, nice. Selling that put is a bullish bet. It is indeed. On the flip side, with our call credit spreads, or bear call spreads, we're going to buy a call at a higher strike price and sell a call at a lower strike price. And you should know from, purchasing calls that the lower down the chain that you go on the call side, the more expensive it is. So we are collecting more money from selling and using that to purchase a cheaper call. And that little difference between the money that we collected and what we used to purchase, that is our credit. Same expiration date, and selling the call is a bearish bet. So if you're bearish and you're selling calls, that's the same thing. A call credit spread is the poor man's version of a covered call, okay? So that's a bearish strategy. and the put spread is a bullish strategy, and it is the poor man's version of a cash secured put. On the other side of the aisle here, debit spreads. Debit spreads are the exact same thing as purchasing a normal call or purchasing a normal put. The only difference is you're reducing your capital expenditure by financing it with a sold call or a sold put, depending on the kind of spread. So in a bull call spread, bull up, call up, same direction, that means it's a debit. We are going to buy a lower strike call, a more expensive call, and then sell a higher strike call, a cheaper call on the same expiration date because it's a vertical spread. For the put side, same situation here, except opposite on the chain, right? Because we know with puts, it's a little different. So we're going to buy a put at a higher strike price, and we're going to sell a put at a lower strike price. Ultimately meaning we're going to have to put up some money. That's why it's called a debit, because when you put up your own money, it's a debit. When somebody else is giving you the money, it's a credit, okay? So the put spread, right, a bear put spread is bearish. A bear call spread is also bearish. A bull call spread is bullish. A bull put spread is also bullish. So just know, whatever that first word is on the kind of spread that you hear, that's going to tell you, okay, cool, this is if they say bear call spread, you automatically, when you hear bear and call, okay, we're talking about essentially a covered call, but the poor man's version, right? A call credit spread. So if that made sense to you, congratulations, you have gained wrinkles on your brain. If it didn't make sense to you, I would love for you to, leave me a comment and tell me, yo, Hunter, this isn't making any sense. Like, I'm not following, I'm not tracking you. Like, what are we even talking about here? Because I love talking about this stuff, and I really think that if you guys who are struggling with a smaller account and you want to be able to get in on the same stuff as the big dogs, but you just don't know how, it's not because the information, or it's not possible. It's just that you don't have access to that information. And if I can bridge that gap for you, then I will happily oblige. Okay. So it is Friday. I'm feeling good. I got like 3-4 more videos in the chamber ready to, just fire those bad boys off. But, yeah, if you like the video, I know I can get a little bit, off track. I need to start putting a bullet point list in front of me so I don't go off on tangents as much, but I hope that you were able to gain a little something from this, just some food for thought over the weekend. And I will be back with another video faster than you can say, oh my God, my puts spread, my call spread, my my debit spread made me $1 million, right? So I hope you guys have a great weekend, and I'll talk to you guys soon, okay? Stay safe out here, enjoy your trading, and until next time, I'm out. Peace.